The market loves a theme: artificial intelligence, dividends, defensive healthcare, infrastructure, insider buying. But themes don't move stocks by themselves. Catalysts do. And right now, the most interesting stock setups are not simply the companies with the best stories. They're the companies where a recent event, a number, a guidance update, a backlog, or a management signal gives investors something concrete to react to. That distinction matters. Because in a market crowded with AI headlines, the question is no longer who benefits from AI. The better question is who has fresh evidence that demand, earnings, cash flow, or investor conviction is getting stronger. Today, we're walking through a catalyst-driven watch list. Taiwan Semiconductor Manufacturing, Broadcom, NVIDIA, First Solar, Quanta Services, AbbVie, a group of infrastructure software names, and one speculative insider buying story in Aldera Therapeutics. This is not financial advice. It is not a recommendation to buy or sell any security. Think of this as a framework for understanding why certain stocks may attract more investor attention, and what could go wrong if the catalyst fades. Let's start with the setup. As of Monday, June 15, 2026, the market is still rewarding companies tied to compute capacity, power infrastructure, manufacturing scale, and visible earnings. But the bar is getting higher. A company saying AI on an earnings call is not enough anymore. Investors are looking for numbers: revenue growth, supply constraints, backlog, margin leverage, guidance raises, and proof that customers are still spending. That puts AI infrastructure at the center of the list. And within that bucket, Taiwan Semiconductor Manufacturing, or TSMC, may have the cleanest catalyst. TSMC is not the flashiest name in the AI trade, but it is one of the most essential. NVIDIA designs the chips. Hyperscalers buy the systems. But TSMC manufactures many of the advanced chips that make the AI build-out possible. The most recent hard data point is strong. TSMC reported May 2026 revenue of about 416.98 billion new Taiwan dollars, up 1.5% from April, and up 30.1% from May 2025. For January through May, revenue was up 30% year-over-year. That is a factual operating catalyst, not just a narrative. The interpretation is this: if AI chip demand continues to exceed available advanced manufacturing capacity, TSMC can remain one of the most important bottleneck beneficiaries in the entire technology supply chain. The forward-looking scenario is steady multiple support, especially if monthly revenue keeps confirming demand. The risk is equally clear. If orders slow, if pricing pressure emerges, if margins compress, or if investors rotate away from AI exposure, that could be the next risk factor. The stock can still struggle, even with a great business. Number 2 is Broadcom. Broadcom has become one of the market's most important AI infrastructure stories because it combines custom AI accelerators, networking, software scale, cash generation, and a dividend. In its fiscal second quarter of 2026, Broadcom reported record revenue of $22.2 billion, up 48% year-over-year. More importantly for the AI thesis, management said AI semiconductor revenue was $10.8 billion, up 143% year-over-year, and guided for AI semiconductor revenue to grow to $16 billion in the fiscal third quarter. The company also announced a quarterly dividend of 65 cents per share and guided total fiscal third quarter revenue to about $29.4 billion. That is why Broadcom screens as more than just another AI name. The company has a near-term catalyst in its fiscal third quarter outlook. The bullish interpretation is that Broadcom can appeal to two investor groups at once: growth investors looking for AI infrastructure exposure, and income-oriented investors who want a dividend attached to that growth. But expectations are high. If the third quarter commentary is less enthusiastic, or if investors decide AI infrastructure valuations have run too far, Broadcom could be vulnerable to a reset. Number 3 is NVIDIA. NVIDIA remains the headline leader in AI compute. The latest reported quarter was extraordinary. For the first quarter of fiscal 2027, ended April 26, 2026, NVIDIA reported record revenue of $81.6 billion, up 85% from a year earlier. Data center revenue was $75.2 billion, up 92% year-over-year. The company also announced an additional $80 billion share repurchase authorization and raised its quarterly dividend from 1 cent to 25 cents per share. The bullish case is easy to understand. NVIDIA is still the company most closely associated with the AI factory build-out. Its GPUs and systems are central to training, inference, and large-scale data center workloads. But because the company is already such a market darling, the risk is not that NVIDIA is weak. The risk is that investor expectations are nearly heroic. When a stock is priced for dominance, even strong results may need to be stronger than strong. So why rank NVIDIA behind TSMC and Broadcom in this catalyst framework? Not because NVIDIA's fundamentals are worse, they are exceptional. It's because the market already knows the NVIDIA story extremely well. TSMC's monthly sales data and Broadcom's next quarter AI revenue ramp may offer slightly cleaner incremental catalysts from here. NVIDIA remains powerful, but upside may come with sharper volatility. Now let's move outside the pure AI chip lane. First Solar is a very different story. This is not a semiconductor stock. It is a US-based solar manufacturer with a capacity, backlog, and execution catalyst. First Solar reported a strong first quarter of 2026, including $1.04 billion in net sales, up 24% year-over-year. Record first quarter modules sold of 3.8 gigawatts, and a contracted backlog of 47.9 gigawatts, valued at about $14.4 billion, extending through 2030. The company also reaffirmed full-year 2026 guidance, including expected module volume sold of 17.0 to 18.2 gigawatts, net sales of $4.9 to $5.2 billion, and capital expenditures of $800 million to $1 billion. S202.q4cdn.com. The catalyst here is execution. First Solar has production scale, visible contracted demand, and a U.S. manufacturing angle at a time when energy security and domestic supply chains matter to policymakers and customers. The interpretation is that investors may reward the company if it turns expansion spending into profitable capacity growth. The risk is that the stock has already had a sharp move in the source material. So near-term profit-taking is a real possibility. Longer-term, capital spending has to generate returns. Backlog and capacity are promising, but margins decide the story. Quanta is one of the clearest infrastructure earnings and backlog stories on the list. In the first quarter of 2026, the company reported consolidated revenue of $7.87 billion, up from $6.23 billion a year earlier. Adjusted diluted EPS was $2.68, and total backlog reached $48.5 billion. Management also increased substantially all 2026 financial expectations. Investors.quantaservices.com. This is a different kind of catalyst from NVIDIA or TSMC. Quanta is not selling the chips. It is helping build and maintain the infrastructure that connects power generation, utility systems, and large load customers. That includes the kind of grid and energy work that becomes more important as data centers consume more electricity. The key phrase for Quanta is backlog conversion. The company disclosed total backlog of about $48.47 billion as of March 31, 2026, with roughly $28.23 billion expected within 12 months. But backlog is not the same thing as profit. Projects can be delayed, canceled, repriced, or executed at weaker margins than expected. So the upside case depends on Quanta turning that backlog into revenue and earnings on schedule. Investors.quantaservices.com. Now, for investors looking for a more defensive profile, AbbVie stands out. AbbVie's catalyst is not AI. It is healthcare resilience, earnings guidance, and pipeline progress. In the first quarter of 2026, AbbVie reported worldwide net revenue of $15.0 billion, up 12.4% on a reported basis. The company raised its 2026 adjusted diluted EPS guidance range from $13.96 to $14.16. Up to a new range of $14.08 to $14.28. Management cited strong performance from key growth drivers and pipeline progress. Investors.abbvie.com. AbbVie also reported strong growth in immunology and neuroscience, including Skyrizi, Rinvoq, Vraylar, Botox Therapeutic, Ubrelvy, and Qulipta. But oncology was more mixed, with the oncology portfolio slightly down on a reported basis. That nuance matters. The defensive thesis is real, but it is not risk-free. Pipeline news, regulatory timing, competitive pressure, and product concentration can all affect the stock. Then there is the software group: Snowflake, Datadog, JFrog, MongoDB, and Twilio. This is less of a company-specific catalyst and more of a group thesis. The idea is that infrastructure software survived a difficult period for SaaS and may be regaining investor confidence after strong earnings reactions. The opportunity is momentum into the second half of 2026. A group that has already rallied sharply after earnings can keep rising if fundamentals improve. But it can also reverse quickly if valuation, growth rates, or guidance disappoint. In this basket, stock selection matters more than the label. Finally, Aldera Therapeutics is the speculative insider buying name. The catalyst is simple. CEO, President, and Director Todd Brady purchased 250,000 shares on June 3, 2026, at about $1.67 per share, for a total of roughly $418,450, according to the Form 4 data reported in market filings. That kind of insider purchase can get attention, especially when the buyer is the chief executive. The interpretation is that management may see value or confidence in the company's path. But this is important. Insider buying is a signal, not an operating result. It does not replace revenue, trial success, regulatory progress, cash runway, or commercial execution. Aldera is therefore a speculative catalyst, not a high-conviction fundamental setup, based on the information here. So what ties all of these names together? The best candidates are not just popular stocks. They have a plausible mechanism for higher investor demand. For TSMC, the mechanism is advanced chip manufacturing demand, showing up in monthly sales. For Broadcom, it is AI semiconductor revenue accelerating into the next quarter. For NVIDIA, it is continued dominance in AI compute, backed by huge revenue growth. For First Solar, it is production, contracted backlog, and U.S. manufacturing expansion. For Quanta, it is record backlog and infrastructure spending visibility. For AbbVie, it is defensive healthcare growth plus higher profit guidance. For Aldera, it is insider confidence, though with much higher risk. There are also honorable mentions worth keeping on the radar. Amazon remains relevant as an AI infrastructure and cloud name, especially because large investors increasingly frame it as more than an e-commerce company. Applied Materials and Lam Research are classic picks and shovels semiconductor equipment plays. Equinix fits the data center real estate theme. Vistra fits the data center power theme. Free cash flow names like TransUnion, Regeneron, Tidewater, and Autodesk may appeal to investors who prefer valuation and cash generation over momentum. But based on the information in this screen, those names have less direct near-term catalyst clarity than the top group. One special case is SpaceX. The input text treated the SpaceX IPO discussion cautiously because some claims sounded promotional, and because the supplier ticker was not identified. As of June 2026, Nasdaq's own newsroom reported that SpaceX, ticker SPCX, rang the opening bell on June 12, 2026, following a highly anticipated IPO. That makes SpaceX a major market event, but it still does not automatically create a clean stock pick in a separate supplier, unless the company and ticker are identifiable and the business exposure is verifiable. Now let's talk about why this matters. Catalyst investing is about timing and evidence. A good company can be a bad stock if expectations are too high. A mediocre company can rally if a surprise catalyst changes perception. And a strong narrative can fade if the next data point fails to confirm it. That is why the top of this list is dominated by companies with measurable evidence. TSMC has recent monthly revenue. Broadcom has guidance and AI semiconductor acceleration. NVIDIA has record revenue. First Solar has production, backlog, and reaffirmed guidance. Quanta has record backlog. AbbVie has a guidance raise and pipeline progress. But none of this eliminates risk. The short-term risks are valuation, profit-taking, and macro rotation. If interest rate expectations change, if inflation data disappoints, or if investors rotate out of growth, AI infrastructure stocks can fall, even when business trends remain strong. The long-term risks are more company-specific. TSMC, NVIDIA, Broadcom, Applied Materials, and Lam Research need AI infrastructure spending to remain durable. First Solar needs expansion capital to become profitable capacity. Quanta needs backlog to convert at acceptable margins. AbbVie needs its pipeline and launches to offset erosion in older products. Aldera needs real business progress beyond an insider purchase. So here are 3 forward-looking scenarios. In the bullish scenario, AI infrastructure demand remains supply-constrained. Hyperscalers keep spending, chip capacity stays tight, and power infrastructure becomes one of the next major investment bottlenecks. In that world, TSMC, Broadcom, Nvidia, Quanta, and related infrastructure names could continue to command investor attention. In the base case scenario, demand remains strong, but stock performance becomes more selective. The market rewards companies that beat numbers and punishes those that merely meet high expectations. In that world, catalyst clarity matters even more. Monthly revenue, backlog conversion, margins, and guidance become the deciding factors. In the bearish scenario, AI spending fears intensify, valuations compress, interest rate expectations move against long-duration growth stocks, or execution disappoints. In that world, even the strongest companies can underperform, and the more speculative names may be hit hardest. The closing takeaway is this: the most compelling stock setups right now are not defined by labels. They are defined by evidence. AI infrastructure still leads because the numbers are big, the demand signals are fresh, and the supply chain is concentrated. But earnings momentum, backlog visibility, healthcare defensiveness, cash generation, and insider buying can also matter when the catalyst is specific enough. If you are tracking stocks that could rise on recent news, start with the mechanism. Ask what has changed, how measurable it is, when the next confirming data point arrives, and what expectation is already priced in. That framework does not guarantee returns. Nothing does. But it helps separate a real catalyst from a market slogan. And in this market, that difference may be the whole game.